Wake up! Let me tell you a truth most people learn way too late. It's not just about how much money you make, it's about how much you keep. And taxes are one of the biggest reasons people never get ahead, even when their salary goes up. You ever notice this? You work harder, you get a raise, you feel good for about 2 weeks. Then you look at your paycheck and think, wait, where did the money go? Wake up! Because if you don't understand taxes, you'll keep playing a game you don't understand, and you'll keep paying the maximum by default. Today I'm going to show you what tax actually is, in plain language. Why employees get taxed differently than business owners, what deductions and offsets credits really do, and the legal ways people reduce tax without doing anything shady. No fluff, no fake guru stuff. Just clarity. 1. What tax really is. At the simplest level, tax is money collected to fund public services, roads, hospitals, schools, infrastructure. But here's the key. Tax is also a set of rules, and like any system, if you don't learn the rules, you'll lose time, money, and options. Most people think taxes are just one number. They aren't. Your tax outcome depends on where your income comes from, what counts as taxable, what can be deducted, what credits you qualify for, and how well you document it. That last part, documentation, is where most people fail. We stonden steenstreinsau, voila. The tax bracket myth. This alone saves people years of confusion. A lot of people avoid earning more because they think, if I go into a higher tax bracket, I'll take home less. That's usually wrong. Here's the truth. Most systems use marginal tax rates. That means only the income above a threshold gets taxed at the higher rate. Example, simple numbers. If the first chunk of your income is taxed lower and the next chunk higher, you don't suddenly pay the higher rate on your whole income. So, don't fear earning more. Fear earning more without a plan, because the real problem isn't tax brackets. The real problem is when your income rises, but your strategy stays the same. 3. Employees. Taxed first, then you live on what's left. If you're a normal employee, taxes are usually withheld automatically. Your employer takes tax out before you even see the money. So the order is, you earned, tax is taken, you receive the remainder. That's the employee life. And because you never touch the tax money, most employees don't think about strategy. They just accept the default. But you still have options. Not as many as business owners, but you do have options. 4. The two big tools. Deductions versus credits, offsets. Most people mix these up, so listen carefully. A deduction reduces your taxable income. It lowers the amount of income you're taxed on. A credit, offset, reduces your tax bill directly. It's more powerful dollar for dollar. If you understand this difference, you stop making rookie mistakes like, I spent money so I could get a deduction. No. Spending $1 to save 30 cents is not a win. Deductions aren't free money, they're discounts on tax sometimes. The goal is, spend intentionally, not just to reduce tax. 5. How an employee can legally pay less tax. Practical and realistic. Here are the categories that commonly matter for employees depending on your country. A. Work-related expenses. Only what's legit. If you spend money because of your job, you may be able to deduct some of it. Examples often include tools or equipment required for work, uniforms or protective gear, certain professional memberships, training, education that is directly related to your current role, work-related travel or mileage, when not reimbursed. Some home office costs if you work from home. The rule of thumb is, if it's personal, it's not deductible. If it's truly work-required and documented, it might be. And documented is everything. No receipts, no proof, no deduction. B. Retirement contributions, the underrated tax strategy. In many countries, contributing to approved retirement accounts can reduce taxable income. This is one of the few strategies that reduces tax today and builds wealth for later. It's like a double win. Tax efficiency, plus future independence. But the details matter. Limits, rules, withdrawal conditions. So you always verify how it works where you live. C. Charitable giving, if applicable. Some systems allow deductions or credits for donations. But again, don't donate just for tax. Donate because you mean it. D. Health, education, and family-related credits, where applicable. Some places offer credits for education costs, child-related expenses, health insurance, or medical costs. This is highly location-specific, but the concept is universal. Go find what you qualify for. Most people never look They pay full price by default. 6. The employee reality check. Even with all of that, employees are limited because they don't control the order. Employees are mostly earn, taxed, spend. And this is the turning point where most people finally understand why business owners seem to pay less. It's not always because they cheat, it's often because they have a different structure. 7. Business owners, expenses first, tax second. This is the big difference. Business owners typically operate like this. The business earns money, the business pays legitimate expenses, what's left is profit, tax is applied. That order changes everything. Employees get taxed before they soldates da and she's offseka she and sort out de board at botten staan. Then that the staten protten stick on sea, so on doerman schuen botten say den the die. So six of the sea. Businesses will calculate profit after expenses. So business tax strategy is mostly about what counts as a legitimate expense, how you document it, and how your business is structured legally. Wake up! This is where how the system works becomes real. What business owners can deduct the right way. A legitimate business expense is usually ordinary and necessary for earning business income. Common categories: software subscriptions, marketing and advertising, office supplies and equipment, internet phone used for business, professional services, accountant, legal, etc. Business travel, with rules, vehicle usage for business, with mileage logs, education directly related to the business, rent or co-working, contractor costs, insurance relevant to the business. But here's the trap. People hear deduction and go crazy. They start trying to write off everything. That's how you get audited. That's how you create stress. That's how you lose credibility. Smart business owners do one thing better than everyone else. They keep clean records. They separate personal and business accounts. They track categories. They keep receipts. They document purpose. Because the best deduction in the world is useless if you can't prove it. 9. Depreciation, the concept that confuses everyone. When a business buys equipment, computers, cameras, machinery, many tax systems don't require you to deduct it all at once. Instead, you might deduct it over time. That's depreciation. The logic is, this asset helps you earn money over multiple years, so the tax benefit is spread. Some systems also allow accelerated deductions for certain purchases, depending on rules. The big takeaway: business owners can often get tax relief for reinvesting into tools that grow the business. That's why you'll see businesses constantly reinvesting, not because they love spending, because reinvestment can be tax efficient and growth efficient. 10. The pay less tax mindset most people get wrong. Let's fix the mindset. Paying less tax is not about buying random things. It's about earning income in a more tax-efficient way, documenting legitimate deductions, using the rules intentionally, planning ahead instead of panicking at tax time. Here's a simple rule: tax time is not the time to plan. Tax time is the time to report. Planning happens all year. 11. A clean example: employee versus business owner. Let's say two people each make $100,000. Employee: they earn $100,000. Taxes withheld, they live on the remainder. They might claim some deductions later, but they have limited control. Business owner: the business earns $100,000. The business pays legitimate expenses to generate that income, say $20,000. Now profit is $80,000. Tax is calculated on profit, plus other applicable taxes depending on structure. Same revenue, different order, different flexibility. And if that business reinvests in tools, marketing, and growth, that can change taxable profit further. Not because they're cheating, because the rules treat business activity differently than wages. 12. The big warning: write-offs aren't magic. If you remember one thing, a deduction doesn't make something free. If you spend $1,000 and your tax rate is 30%, you might save $300 in tax. You still spent $700 net, so don't buy stuff to save tax. Buy what grows your life or business anyway, and then claim what's legitimate. 13. What people should be very aware of. Here are the biggest tax mistakes that keep people broke. 1. No tracking, no receipts, no proof. They guess numbers, they forget expenses, they lose deductions. 2. Mixing personal and business spending. This creates mess, risk, and confusion. 3. Waiting until the last minute, then they miss deductions, make errors, and panic. 4. thinking tax strategies are hacks. Real tax strategy is boring. Records, structure, compliance, planning. 5. Not understanding withholding or estimated taxes. Some people get surprised by a tax bill because nothing was set aside. Know your obligations. Plan for them. 14. The wake up. Conclusion. Here's the big truth. Taxes reward structure. Employees can reduce taxes with smart deductions and credits, but they're limited. Business owners have more flexibility because of how profit is calculated, but they also have more responsibility. Either way, the message is the same. If you don't understand taxes, you will overpay by default. Wake up! This isn't about avoiding taxes illegally. It's about learning the rules so you can legally optimize. Because financial independence isn't only about earning more, it's about keeping more and building systems that protect your money. So start here. Learn deductions that apply to you. Track everything. Separate accounts if you run a business. Plan all year, not at the deadline. And when things get serious, talk to a qualified tax professional. You don't need to be a tax expert. You just need to stop being tax blind. Wake up, because the system is happening whether you understand it or not.